Okay, great. Thank you. Thank you. All right, good afternoon once again, from wherever you're joining us from. It gives me great pleasure to welcome you to our maiden webinar by the Oak Capital, where we're going to be talking about the overview of the venture capital ecosystem in Africa, giving you a rundown of what happened in the year 2022, and also our projections of what we expect for the year 2023. So it promises to be educating and enlightening. So thank you all for joining us, and you're sure to have a great time with us today. So by way of introductions, we have our guest speaker in the house already, and I'm just going to go straight to the introduction. So we have with us the CEO of the Oak Holdings, Mr. Olukayode Olusanya. We have the second guest speaker, we have Adedamola Olabinton from Sayo Capital. And also we have Adeyemi Adegbayi, an investment professional with TLCom Capital. So, I mean, you'll get to hear their voices any moment from now. So I'll just go straight to do a brief reading of their profile, if you indulge me. All right, so I'll just go straight to the first guest speaker, the CEO of Oak Holdings, Olukayode Olusanya. So Olukayode Olusanya is defined as being audacious, innovative, and strategic. He's also a serial entrepreneur who aims to create value for national economic growth. So Olukayode holds an MSc Financial Economics from the University of Leicester and attended the prestigious Wharton Executive Education Program on Venture Capital. So he's also studied at the Lagos Business School for Public-Private Partnerships. He's a well-experienced financial corporate market expert and a captain of industry in the Nigeria real estate space. He is the founder and chief executive of the Oak Holdings, which include Oak Homes with operations in the free trade zone area, Nigeria and UK. He's also the CEO of the Oak Capital, a venture capital firm in the investment management space, and recently the Oak Capital Fund Managers Limited, an asset management in Nigeria. Olukayode sits on the board of several companies and has over 15 years of banking experience and more than 8 years in core investment management in the real estate sector. Some of his awards and recognitions include special focus on most impactful CEO by The Guardian in 2022. He's also one of the 20 best performing CEOs in Nigeria by the Blueprint newspaper. And additionally, he was also named as one of the 50 CEOs of distinction by the Vanguard newspaper. So permit me to welcome Mr. Olukayode Olusanya. Can you just say a word?
Thank you very much.
All right.
Thank you very much.
It's great having you here today with us. Thank you. So permit me to go to the second guest speaker. We have Adedamola Olabinton, a senior investment analyst with Sayo Capital. So Adedamola is a seasoned investment professional and currently works with the investment team at Sayo Capital, where she's responsible for screening and evaluating multiple investment deals in Africa for potential investment. She has experience investing in the agricultural value chain in Nigeria. And prior to joining Sayo, Damola had a vast experience in investment banking, with the recent experience being the team lead at Imagine Africa Capital Group, a Pan-African investment bank. At Imagine Africa, she was responsible for assisting different institutions, both public and private, to raise debt and equity capital. She also has experience in providing financial and transaction advisory services, which covers due diligence, valuation, corporate and project finance modeling, fundraising, among other side services across various sectors. And she has very strong interest in the venture capital space in Africa. So Damola, you're welcome. Can we hear your voice?
Thank you, Biodun. Thank you for having me.
Thank you for being with us today. And last but not the least, we have Adeyemi Adegbayi, who is an investment professional at TLCom Capital LLP. He has over 5 years of experience working in Africa's venture capital and technology industry. is currently focused on investing in founders across Africa by providing equity financing to innovative businesses on the continent, where he is involved in all stages of the transaction process, which ranges from deal origination to structuring and execution. He's skilled in investment analysis, valuation, due diligence, fundraising, and portfolio management. Adeyemi is also passionate about supporting underrepresented founders in emerging markets, where he does his work through Purple Chip and Nano Traction. He's a notable public speaker on venture capital, and he has a bachelor's degree in computer science from Babcock University, and he's also a Newton Venture Fellow. So permit me to introduce to you Adeyemi Adegbayi.
Hi, everyone. Thanks for having me here today.
All right. Thank you. Thank you, everyone. And let's get right into it. All right. So my first question is just, I'd like to ask our panelists, and I want Mr. Kayode to take the first thoughts on it. I mean, all the panelists to be also giving their thoughts on it, but I'd like Mr. Kayode to go first. So in your own words, how would you describe the venture capital ecosystem in the year 2022? So if you would give a recap of what happened in 2022, so what would be your thoughts in 2022 in the venture capital space?
Okay, hi, Biodun. Thanks, everyone. Thanks for joining in, and thanks for having me. Okay, so first and foremost, I would like to give a quick background to where Africa has come from before I take a dive into the Nigerian ecosystem and streamline. So there's a great achievement that has happened so far in the VC space, in the sense that, traditionally before now, the VC ecosystem in Africa, as I can describe it as now maturing, right? Before now, when you're talking of digital innovation in Africa, it usually would be an aid subsidized activity where you have people rolling out cameras, for non-profit reports and patronizing media. You take pictures that, okay, Africa, you are investing as an aid in Africa. But right now, people are seeing Africa as some kind of investment destination, a business-worthy trappings of wealth creation, right? Where you can come into Africa to invest in businesses, and it has seen the flow of FDI in real terms, and it's growing, right? And I'll give an example to that. In the last US Africa Leaders Summit, you realize that there was quite a lot of conversation about investment, especially in the VC space. And there is a blowing $15 billion commitment into investing in Africa. To be honest, from where Africa has come, and of course, I like to think myself as Pan-African, right? That is a huge stride we have taken. So I think the investment VC space in Africa is actually maturing. And taking it away from that, I would say that 2022 in the African tech has been a most defining year. And it also can be defined as the year of the Great Correction. Great correction in the ecosystem where, because of rising inflation, which has its attendant, interest rates and everything that accompanies, that. And of course, there's a threat of recession in quite a number of the Western economies. So as you have it, Africa is actually one of the, in fact, it's the only continent that actually recorded some growth, positive growth. Ouch, okay. Can we mute everyone? So, hello, ouch. Hello?
Yeah, we can hear you.
Moving on, we talk
Okay.
to
Can we mute everybody, please?
setting.
Hello? Hello?
Okay, I'm working on that.
Hello?
You're muted. Yeah, you can speak on now. We can hear you.
We can hear you, sir.
Okay, so 2022 can be described as the year of great correction in the tech ecosystem. And so what that means basically is that, we have moved from, there was minimal cutting of checks from 2021 in 2022. And everybody is now very careful of where to cut checks, what direction to look at. okay, so what kind of transactions do we look at going forward? So there's been a movement and everybody is now sitting up, so to say, that, okay, if you are cutting checks, where is the check going, into what activities, into what productive, how productive is that sector, what's the underlying business model we are funding. So quite a number of things are now at the foreplay, which hence it's been tagged the Great Correction. So I would say it's become quite interesting. And of course, part of the $15 billion investment that I mentioned earlier is when M-Pharma, of course, mentioned also at the event that a $40 million is coming into Nigeria, is venture-backed business in Nigeria. So interesting times are ahead because there's a correction and quite a number of things which is Africa right now, and we'll delve into that subsequently.
Okay.
Hello.
So, Adeyemi, can we hear your thoughts around
Yes.
overview of this in 2020?
Yeah, so just in line with what Mr. K said earlier, I think a lot of the things we saw were corrections from VC behavior we saw in the years prior. So 2020, 2019, there were a lot of really crazy VC activities around valuations, a lot of eyebrow raising from investors. And then looking at it globally before bringing it back to the local market. So there was a 35% decrease in the total funding from 2021 to 2022. I think it was a bit slower to reflect in Africa, but then when you look at the relative size of Africa compared to the rest of the world, and even the level of growth stage checks that have been written in continents, like it's evident that happened. And then even last year, we saw less ecosystem defining incidents like additional unicorns coming, and then also less growth stage investments, which I think is a trend that we would see for the near future. But then overall, I think it was an interesting period. Difficult for a lot of groups of people, particularly emerging managers, which are a big chunk of the investors in continent, because fundraising became hard for founders, but it became harder for emerging managers just because there are more people and more LPs who are suddenly more reluctant about writing checks, and not just because of the risks associated with VC, but because a lot of people took real asset losses as a result of the markets. And then also suddenly credits became more attractive in developed markets as an effect of increased credit rates.
Okay. All right. Thank you for that brilliant thought. So Adedamola, so I mean, both speakers have said reduce interest in investors and ops. What do you have to say to this?
I mean, I'll probably just feed off, what they've said, because it pretty much encompasses what has happened in the market. So just to add, right, now in retrospect, 2021 seems like the outlier year, right? Just as Yemi mentioned that there was a dip, from 2021, so relative to 2022 of about 35% globally. And funny enough, I mean, just in 2021, any company that is just at, even at a minimum pace of growth, you most likely get capital. But that dynamic seems to be changing. I mean, major reason because of the contractions in developed markets, they are facing problems in their own end. So definitely capital is more expensive. Typically a flight to safety. So because the developed markets, they are seeing that what are the benefits of us moving to an emerging market when we can just stay here? So you're seeing a flight to safety, flight to quality. So definitely that will reduce the amount of capital inflow into Africa. Yes, so and that was particularly seen in the second half of last year. So that's a dynamic that, although there's only so much that we can do about it, we can only hope that it doesn't go on into the future. Thanks.
Okay, thank you everyone. So back to Mr. K, you mentioned a point around market correction, all right? And I just wanted to give a thought on this. This market correction that is coming, so it's going to be a twofold question. So is this market correction trying to bring these startups back to their real valuation, or are these startups, are they overvalued? So is this market correction trying to sort of bring them to their real value? And this market correction also, are we beginning to see it flow into Africa and Nigeria by extension?
All right. So let me just, okay. So I'll just quickly answer that question and say this, right? So in one of our investment conversations at Deal Capital, right, we have, of course, we get quite a number of deal pipelines that we look at and review. And, you know, something that you realize that was quite interesting was that quite a number of founders, right, that probably should still be bootstrapping, still trying to get their ideas together, still trying to, you know, trying to even put the thoughts process. Let's leave the idea out. And you know, the next thing is they want to raise, and you check at what valuation, and somebody tells you that I'm trying to raise at 10 million valuation, and you ask the question that, okay, so what is the product? Can you discuss the idea? And you realize that some of these conversations are kind of ridiculous, right? So, and because, of course, if you look at, so what is the alternative buckets of investments, and you realize that, hey, I can't be having this conversation because you need to go and get some job done, go and get something done. So what am I saying? Valuations have come down to a more reasonable level, you know, and that's because right now, whatever capital you have available, everybody's careful not just to cut checks that might never come back, right? You know, so even though you have funds that are going to come to Africa, or because Africa has kind of been, positive, right? You know, a lot of VCs are now doing more due diligence. So it's not just a case that I need to expend my fund, I need to expend this dry powder. You know, everybody is now looking at the due diligence that, okay, yes, should I put my money here? Is putting my money, is it going to give my LPs the guaranteed returns I've promised them? So valuations have also come down to reasonable levels. People are now looking at ideas, you know, they are looking at, because there's a lot of macroeconomic headwinds here and there that you can't just afford to be careless. So so valuations have come to reasonable levels, and now we are looking at the reality of things, not just speaking from the entire so that's my thoughts.
Okay, interesting. And I mean, during the era of 2020, where there was so much money in circulation, free money, you would say, a lot of startups were raising funds, absurd valuations and whatnot. So I think the market corrections were necessary to actually prune those that have feasible ideas and that are able to scale. All right. Adeyemi, I mean, part of your profile says you are quite interested in underrepresented founders, especially within the emerging market. So I'd like to hear your thoughts about underserved and underrepresented founders. Who are these guys exactly? Where are they? And how has been their ability to raise funds?
Yeah, so I think there are a lot of ways you can define underserved and underrepresented founders just based on what lens you're using. So for example, by the result of being Black or African or a person of color in the global scheme, you're an underserved and underrepresented founder. So that means just investing in continent, you're already investing in founders that in the global scheme are underserved and underrepresented. But then there are now interesting subsets, like female founders are also underserved generally, and more in particular, female founders of color. So this being female founders of African descent, LATAM descent. So interesting numbers, even in the US. So in 2021, 24% of total funding went to female founded businesses. And then after the total size of that pie dropped into 2022, the percentage that was taken by female founders also dropped to 1.9%. So this was both relative and absolute. And then essentially, like when we look at VCs, there's a lot of VC bias that we've come to realize is reality, where you see people building products that you don't necessarily understand in a sector which is mostly dominated by people who fall into a particular demographic I'm not going to go into. But then there's a good chance that you're likely not to invest in these people. And I think in my experience, what I've seen is there are a lot of people that are working on programs for female founders and underrepresented founders. But one of the most important things for these groups still is access to capital. So to a large extent, there's a lot of mentorship, which is helpful, but then the bottom line is still, I'm a founder, I'm trying to build, are you going to give me money? And then so beyond gender and race, there are also other things like backgrounds, because certain backgrounds are green flags for VCs. And it's a business where you learn to see certain indicators as a sign of certain deals being great. But then what happens in the reverse end is when people don't fall into those buckets, they might not be building poor businesses, but they're already starting from a place of disadvantage. So it's just trying to find a way to create founder equity, regardless of background, race, color, geography they're building in, etc.
Interesting. Okay, so that brings me to question on female founders getting checks. And I think it's apt to ask the female guest speaker we have on the call. So Damola, what would you say in this regard? Female founders and their ability to raise funds. Are the funds there? Are they able to access it? As the journey been for female founders?
I think, from observations and everything, I think one of the things that we can all agree on is there's a bias, right? So there's a bias to, even if your business model makes sense, right? Even if all your unit economics, everything is in place, right? There's generally a bias, and there's only so much you can do about it, right? So, but on the other hand, thankfully, there are a couple of, initiatives going on, things that there are different people from different backgrounds are putting in place just to ensure that this is reduced to, a drastic extent. But one thing I'm also certain of is, to a large extent, I believe this correction, call it anything, this market correction will make, VCs to double down on diversity. So if you're in doubling down on diversity, that's probably a diversifying strategy for you. And in doing that, chances are that you'll be able to focus more on, underrepresented, areas. So take, for example, race, gender and the likes. So good commendation to initiatives that have gone into trying to make sure that underrepresented founders are seen and funding are provided for them. But I think the core thing to also focus on is, while acknowledging that there is a bias, right? What can female founders do better? Right, in your pitch, in your delivery and everything, what can you do better? And I think that's something to focus on, really. So on the part of the founders, of course, the bottom line is, can I get funding even if all my ideas make sense, right? And like I said, thanks to people who are making, a good effort on that base, right? But there's only so much you can do. But I'm very certain that in the coming months, in the coming years, things are definitely going to get better.
Yeah, things are going to get better. Permit me to play the devil's advocate. Mr. K, would you agree that there is a bias? And as a VC, what are you doing at Oak Capital, if any, to address this bias and serve underrepresented founders?
Okay, so to start with, yes, there's a bias. In fact, there is a huge bias, and I'll tell you why. So now there's a checklist of sorts that I'm sure every firm must have designed before you look at some investments, right? So so there's a particular way, there's a pattern, right, that traditional venture capitalists look out for. So number one, I'm just saying, right? I'm not going to pin this on any. So number one, did you school in a particular place? Where are you from? What do you look like? Are you male, female, or whatever? So there's a pattern that's been developed on that checklist. And to be honest with you, so what happens at the end of the day is probably 99%, because at the end of the day, most new startups, probably less than 1% of new businesses will raise venture capital, right? So you have streamlined about 99%. And what does that tell me? So in the 99%, I can guarantee you that you still find some exceptional entrepreneurs who have all the pieces to build, and scale category defining businesses. But what has happened is that, once you throw away that 99% bucket, Oak Capital is designed to take care of at least, a chunk of that 99%. So what does that mean? So we are trying to create an efficient market for talented founders at the earliest stages at the Oak Capital. So we call them underserved. So we are looking for entrepreneurs who don't have the fast track in life, right? Everything seems not to have checked out, but you have a brilliant idea that can scale and some other metrics which we have also designed. So those are the kind of people that we are looking for. The products should be tech enabled, should be from undeserved communities, for example, all kinds of backgrounds, female, male, so that's the idea. So long as there's a promise and there's a potential, you are the kinds of people we are looking for, right? So, and it's been pretty clear, when you ask that question and all that, the traditional venture capital industry had made it very clear that some capital is not meant for them. That's the truth. So what we're trying to do right now is we are trying to bring them in, so where they would otherwise have been outsiders, we are saying you are welcome, talk to us and would provide you whatever enablements you need, whatever infrastructure, funding that you need. And, so yes, we are willing to go into the untapped area and try to make an efficient market from it. Thank you.
All right. Thank you. Interesting thought there. So, I mean, we were able to align on the same thought that the need or the bias exist. And I mean, there are a couple of firms that are doing interesting stuff to address these issues. All right. So permit me to introduce my co-host, Olajumo. So he has a question.
Hello, everyone. Olajumo, like Abiodun said. So my question, I'm actually throwing this question to Yemi, still on the topic about gender bias, right? So like from everything everyone has actually said, Mr. K to Yemi and Damola, right? The idea I'm actually trying to like get to is focusing on the idea that single male teams are actually like the most funded, most funded startups. But we've come to see that some data actually lends to diverse teams as opposed to either a single male team or a single female team are the most successful startups that actually tend to like, grow pretty fast, hyperscale, blitzscale, and any how you want to like put it. So my question is, should there be like a reorientation away from actually trying to raise the amount of funding that goes to single female founders and actually focus more, at least here in Africa, for a far much more diverse team? So for example, maybe as a VC, I'll not touch your team with a 10-foot pole if your co-founder is not female, or at least 40% to 50% of your team is not female represented.
So, to my mind, I don't think any groups should be excluded when you're looking. It's around providing a platform that allows equity regardless of whether you're an all-male founder team, you're an all-female founder team, or you're a team with both male and female founder. There's an article that we responded to internally last year, which was looking at, actually 2 years ago, which was looking at female-founded investments in Africa. And then we asked ourselves questions before sending responses. And the reality, so there are certain male stereotypes that we look out for when founders are pitching. And this is very unintentional, but like there's a certain way you want a founder to pitch. And then if you picked a group of 10 people, 5 male, 5 female, there's a good chance 4 out of the 5 men would do those things, and then 1 out of 5 women will. And then this is just nature. But then we've then picked some of these things, like you see more aggressive type founders, people who would sell over the moon, which are typically male traits. I think when speaking with people that work in HR, they're like, look, it's more likely for a guy that's not qualified for a role to apply for it than a woman who is not. And these are just some of the things that we look at as very good signs. So I'm just saying we shouldn't say, look, we're investing in only teams that have mixed gender, because then you block out a lot of people. But it's just trying to make sure when looking at everyone, you have lens focused on the right metrics. And then, so for example, there's this random piece of data, and I can't pull exactly where I saw it, but that said teams with female founders are likely to overperform in terms of the percentage of them that get follow-on funding compared to teams with only male founders. So I think the answer to that is very simple. It's either use the same lens that you use when looking at female founders for everybody, and then automatically you kind of get less teams will get funded, but then the teams that get funded will teams that are essentially able to go the long way. Or a reverse end is, okay, maybe female founders are just stronger, and then reduce the scrutiny, and then you get more businesses also that go past these lines. So it's really none of those, but it's really providing equity for everyone, and not saying, look, I'm just going to invest in you because you have a female co-founder. But then also where we see there are gaps is providing platforms that allow people to feel included. And this is stepping a bit away from VC, but I have this thesis, which is you're very likely to want to do something if you've seen a lot of people that look like you doing it. So it's not just, I chose to become this because this is this vague thing in my head. You see people, you relate with people, and then you're able to essentially put yourself in their shoes before moving towards things. So it's now first providing a platform for everyone, but then people who are in these spaces need to do a bit more work to become more visible. So people who look like them, see them, and then can dream to be them or dream of being them.
All right, cool, nice, well said. All right, then Biodun.
All right, thank you for that. All right, so I mean, moving forward, because we don't intend to keep you here all day. So moving forward, I would like to set a context. I mean, if you look around our ecosystem, you can probably by closing your eye, you can just mention a lot of startups that are popping up by the day. And the interesting thing is that most of the problems or most of the needs that this startup claim they want to solve, to a very large extent, they remain unsolved. All right. So I mean, the question or the conversation now goes to, do our startup, do they actually possess the capacity to compete on a global scale? All right. I mean, it's not just about coming up with an idea, but the needs still remain unsolved. So I'd like to ask Damola, do you think our startup possess the capacity to compete and scale on a global level? I mean, beyond Africa, beyond Nigeria. So does our startup, with what you're seeing currently, so do this startup possess this ability to compete and scale on a global level?
Okay, I think for me, the honest and simple answer is yes. So take into consideration so many things. So I want to start initially from traditional companies. I don't want to, not startups now. So who have been able to, start locally, build something locally, and then eventually build up to, global standards. The question is, are you doing that thing? Do you have the capacity to do it? Most certainly yes, but are you going to do it? So are you going to do the thing that will make you become acceptable and globally accepted, sort of? So I think the question is, I mean, for me, first of all, if you're able to conquer your local domain, so if you're able to conquer Nigeria, chances are that you'll be able to conquer the rest of the world. So there are things that any normal startup should take into consideration before you can say that you want to set a global stage. So how is your operations like? Your operations, do you have operational excellence? Of course, startup, the old dynamics in the past couple of years has been that just have revenue growth and then you're good to go. But it goes way beyond that. You can't just bank on revenue growth and then expect that whole cycle will continue. So there are startups who I believe that, and I have reservation about a couple of startups, to be honest, right? But I believe that there are startups whose models make sense, absolute complete sense. there's transferable, this same thing that you're doing locally, that's transferable to other international markets. And to also add, we still have lots of problems in Nigeria. And then I know a couple of times people will ask on Twitter that, okay, we are facing this type of problem, right? But it looks like no startup or nobody has been able to conquer it. So it just sets the stage that there's still a lot of things to be done, right? Do they have the capacity? Is there the ability to eventually scale up to that global stage? Definitely. But of course, it takes work. It's not a day work. There are international companies, there are good companies in Nigeria who are, okay, not startups now, but I mean, they've been able to grow from a early growth stage and then develop. And they've been able to, scale up to a very reasonable stage. So in the same vein, I believe startups can reach that stage, but it's not a day job. It's not a 2-year job, right? But is it doable? Most certainly. Biodun, can you hear me? Oh dear.
I think Bjorn got disconnected.
Oh, look at that.
Okay, so whilst we're waiting for Bjorn, right? So one of the things I think, hello?
We can hear you.
Okay, so I think, right, one of the major reasons, so to answer the question, yes, I think African startups can actually compete and scale on a global level. Yes, no doubt about that. But one of the things I think is quite critical, I will address two things with respect to this. Number one, there's a report, I think Business Day was one that did that report some time ago, that every new startup, right, that there's a chance that 80% of every startup would fail within the first 5 years. I think everybody kind of knows that, right? Now, why do businesses fail, or startups, as the case might be? So I would use an example. So Jumia is one of the startups you can say are successfully scaled on a global level, right? And guess what? It's also the most funded startup in Africa, right? I think it raised about $885 million across 6 funding rounds, in 7 years. So it's very much funded. So, and also Tech Cabal also now added some flesh to this, or some thoughts. He says, one reason why these successive failures in startups is the drying up of venture capital funding. So that takes me a little bit a step further. So what happens, or what I've realized, of course, in this VC space and the ecosystem, is that you have a founder that has all the tech skills, has all the right ideas, and is the guy to get the job done, right? But there's a missing business angle or business sense to some of these things, right? Where you need frugality to manage some of these funds, because your burn rate now goes up the roof. Now you are burning, how do I even say, you burn faster than you are likely to even generate. So profitability is on the decline, but you have a very good business idea. You're not chasing after the business side of things, even though you have a very good fundamental, you have a very good business model. So at the end of the day, business is going to fail, not because they don't have the right ideas, but because, there's nobody even chasing the business side of things. So that's why they will not compete on the global level and will die. That's my thoughts.
Yeah, maybe I can just.
Yeah.
I couldn't agree more. Sorry. And to be honest, I feel like that's majorly the problem of African startup, or just Nigerian startups, right? Yeah. I feel like eventually you raise money and then you just sort of divert from the whole purpose of what your business is supposed to solve. Yeah. I feel, and then they focus on what they're not supposed to focus on, right? And you're right? It's not just startups. Majority of businesses fail. It's just, so like I said, it's not a day job. It's not a 2-year job. It's a long-term job. And it depends on how early you're able to get it right.
Yeah, I want you to also weigh in on this.
Yeah, so I think first I'd say some startups will be able to compete on the global level. And that's a very political answer, I know, but as startups grow, so startups die, and then startups have to evolve. So I can't look at a seed company today and say, okay, based on this, you'll be able to compete on a global stage. Because even as we look at startups, there are things that you require as a Series B business. And the way you grow and basically go through your market and your business evolves often determines whether or not you'll be able to compete on a global level. So I think there are a lot of startups that will just never get to the point where they're able to answer that, can you compete on a global level question? Some of this being faults of the founders and their teams, and some of them just being the market conditions where we are. So internally, and then with startups we speak with periodically, we learn that people go into the market with certain thesis. I want to build X, Y, Z, which sounds like a great value proposition. You start building X, Y, Z, then you realize the infrastructure to support X, Y, Z does not exist. And then there are worlds where the infrastructure necessary to support your business model are profitable. And then that means you have an additional revenue stream. And then there are also certain cases where the infrastructure necessary to support is not very profitable. And then suddenly your margins go very low. And then you need more cash and you have to keep burning until you get to that break-even point. So I think it's both ways. And then at the end of the day, when businesses grow and scale very well, we have African businesses that are able to essentially now start to compete on a global level. And then we have seen businesses that, whether be it on the demand or supply end, they've gotten to the point where they've started competing with their global counterparts. I think a good example that comes to mind from our portfolio is Andela. So by all regard, at this point, Andela is a global competitor for similar businesses. And that's a business that started out of Africa, started with talent in Africa. And as they saw different hurdles, they saw the need to adjust their business model and adapt. Some of those things were taken very well by the ecosystem, some not so well. But then those adoptions and essentially the evolution led them to the point where they could compete on a global level. And I think the biggest hurdle the market creates, so beyond those other things, is talent. So as you grow and scale and you look to compete and you look at things like expanding to new markets and then potentially trying to attract larger checks from investors that just don't exist in the market, your team needs to evolve to a place where there's a lot of talent that just doesn't have that experience in the broader Africa region or in SSA. So there's some of that talent that exists in like the MENA region because big tech historically have employed more people from Egypt through like their MENA teams than rest of Africa. But then I think those are some of the things that founders also have to actively think about. So it's, you grow, your stage is changing, but your startup needs to evolve. And then without that evolution, it's very difficult to tackle global problems.
All right, interesting. I mean, we're able to come to terms that the capacity to compete globally is there. But I mean, there are some other factors associated with this ability to compete. I mean, just like Emi mentioned, your team, do they possess the technical capacity and skills to also pivot into all these, and also your startup life cycle. So you also have to connect with the changes that come with evolving. All right. I want us to touch on an interesting point, and the fintech industry. So who do I start from? Okay, let me start with Yemi. Yemi is smiling already. So the fintech space, is it over-bloated?
Personally, I don't think fintech is over-bloated. So when you look at the chart, there are certain sub-fintech sectors that a lot of capital has gone to. A lot of capital has gone to new banks, but then financial technology is beyond banking. Like there are non-bank services that barely scratched across the continent. And then there are also parts of the continent where even these banking services just aren't there. The two most underbanked countries in the world are African countries, Morocco and Egypt. So we've seen capital maybe very concentrated in certain markets, but then when you look at the infrastructure in Africa, you see there's still a very big gap. Like I can't just wake up today and say, I want to send money to Kenya and then click and be 100% sure that someone in Kenya gets it immediately. Like that's a very tiny use case. And then there are a lot of people building for this, but there are a lot of hurdles. And I think fintech will always receive the lion's share of investment. Like globally last year, I think it was 37%, the year before 50 something, because once your finance infrastructure works, essentially everything else is able to be built on it. And then once you start to create more value for consumers and then more people move above the poverty line and then they have more money, essentially they still need financial services to cater to this. So there's first the part where there's some of the infrastructure that just doesn't exist or is not optimal yet. And then definitely more money will still go towards optimizing. And then there's the other side where in Africa, there are a lot of people that haven't even come to the point where they have disposable income and they're starting to think about how does this disposable income work for me. But I think across most financial sectors, we're still like way behind what the global standards are. It's things like the average Nigerian can't get a mortgage. There's one mortgage available that makes sense, but still, you get it once in your life. So there's just a lot of things. And the bigger the problems are, the more capital potentially will go towards solving them.
What about the idea, right? Let me just cut in there. What about the idea that you see, you probably go through a lot of like, fintech deals, you look through a lot of decks. There's this idea that comes to your head when like, you go through screening these decks, you just kind of wonder, are founders just jumping into the fintech space just because, like you mentioned, the lion's share of funding actually just goes there. They feel like it's easier to actually create like a fintech product. So there's not much real innovation or actually ideation when it comes to actually building for the ecosystem, right?
I wouldn't say there's no innovation. Sorry, I'm very founder friendly, by the way. But I wouldn't say there's no innovation because with every sector, we see decks that are not differentiated, but then every other day you see decks and you speak with founders that are solving very big problems and truly understand how to solve those problems. I think the biggest sector in Nigeria is banking, for example. I think no one hires, I think beyond security companies who hire the most people, no one hires more than banks at the moment in Nigeria. That's how large it is. But then a very tiny portion of the population is banked. There will be businesses that are, sorry?
Sorry, I want to ask a question, and it might help or otherwise on this conversation. Now, would you say there are quite a number, because fintech is quite wide, right? There are different angles to fintech that should be looked at. But would you agree with me that the digital payments side of fintech is where you have a whole lot of people chasing? So you have, instead of these different whatever you have for fintech, you have quite everybody on a particular space such that the other angles of fintech is not even exploited or explored at all.
So
would that be the sense?
I think there are two sides to it. So one is, where are we as a people? And the easiest thing for anyone to relate to is payments, which is probably why people are trying heavily to digitize payments first. Very cash-based economy. The moment we move from cash to digital, like look at Nigeria the last 3 weeks, it's been a mess, no cash. And then it's crazy. But the moment you're able to move from cash to digital, a lot of other things can be put on top of this. So for example, when transactions are digitized, it's easier to make credit decision because you actually see what the inflow outflow is. There's a lot of cash-based transactions that there's just no visibility on. And so I think maybe we can say payments is the low-hanging fruit, but then tackling the low-hanging fruit doesn't necessarily mean it's a bad thing.
Okay, so yes, so that brings us to the same, almost the same point, right? So I think there has been no new innovation in the fintech space. I could be wrong, but you realize that most of the innovations you find is still at the low-hanging fruit, right? That, okay, this thing is hanging, let's just jump at it. But there are various aspects, of course, we have some insurtech, all this kind of whatever it is, but you don't find any innovation or anything new that you can fund at the moment. Think of one. Away from digital payments,
okay, let me
financial inclusion.
Let me just add to what Mr. K is saying. So basically, most fintechs you tend to see are maybe lending-driven models. I mean, you could go through like a bunch of like, if you go out and you source deals, you see like 60% of the deals for fintechs are basically lending-driven models. Most tech founders who actually jump into the fintech space tend to see, rendering credit facility. Yes, it's a very big problem. We don't necessarily have like a credit infrastructure, which is actually is an important way to grow an economy. So yes, there is a problem to solve. So yeah, there are solutions that are needed there. But then you see the innovation, or should I say the product that is offered is basically, I'm taking what a bank should be doing, the legacy bank should be doing, and I'm just adding some spice to it. maybe UI UX, that sort of thing.
Yeah,
you get
but
it.
spice is nice sometimes. So I'll give an example. One of my favorite fintech products in the market, PiggyVest. So PiggyVest brought services that existed already, and then essentially found a way to make this appeal to users. And then through numbers that we hear whispers about, they're one of the larger fintech players. So it's not always about going to create a model that doesn't exist. It's finding problems. Like there's still big problems around payments, etc. And then just essentially finding a way to solve this problem for a large group. I had a conversation with this tech blog called FinTech Pad some weeks ago, and then I think there's an article that was published recently where we're trying to understand what I thought about fintech space going into this year. And then I focused on neobanks because I like neobanks, but then there are some comments, and there were 3 key comments I had. One is we would see a lot of less differentiated neobanks die, which is you're the same as the last 100 businesses I spoke to in terms of traction and ABC. Why should I give you money rather than those? So a lot of those will die. There will be consolidation where some of them decide, you know what, rather than we be 5 businesses, you're great at this, I'm great at this, let's come together and become a bigger business that potentially can get capital. And then you then see people that fall within different subcategories get acquired. So the really semi-differentiated ones who struggle to raise capital, we'll see a lot of acquisitions then happen within that space. Last year, we started to see some fintech, neobank-esque acquisition and whispers of acquisitions. I suspect there will be more of those this year. And these are the smaller acquisitions where you go to join a local player and that player essentially becomes bigger. So I understand the thoughts around differentiation, which is, look, more differentiated businesses are great sometimes, but then sometimes also it might be the exact same model you've seen 100 times over, and then just someone that's cracked how it works. So even when we look at, I think the biggest neobank market is probably Europe. And then you look at the Wises and the Revoluts and all these other businesses, there were digital banks that existed before them. And to a large extent, a lot of them are offering very similar services, but it's now tailored to things like, how do I approach users? What segment of the users am I looking for? And do I have a USP, which differentiates me from everyone else? So I think that's probably where I'll agree with you guys, where a lot of times there's less differentiation. And when there isn't differentiation between 5 decks, there's no real reason to pick anyone.
All right, great. Damola, 60 seconds. What do you have to say to these fintech
Okay,
boards?
I think generally I agree with what everybody has said. And just to give a bit of, additional spice to the conversation. So I don't think regulation, so now we know that fintech is sort of, cramped up. But the honest truth is regulation does not make it very easy to go to other parts of fintech. So there's insurance. Very few number of people who are doing insurance, and very low number of Nigerians actually have insurance. The car insurance that people have is because the government made it compulsory for you to have third party. That's why people have third party. And so if I am a startup, I would think twice before going to go and start something that people don't want to get into. So for example, HMO, what's it called? So, still under insurance, technically. HMO in the same vein is only because of the new regulation now that will make everybody literally get HMO. But aside that, the previous regulation didn't make it compulsory for anybody to get HMO. So if you get it, good. If not, so anybody will think twice before getting into business, because you have to really struggle to acquire people. Fantastic market on paper, which is true, but the customer acquisition is a whole different ball game, right? So in that regard, truly payment is, it's like you said, a low-hanging fruit. So, but the honest truth is the payment stuff is yet to be solved, right? We still have people are still facing challenges in getting payments. My bank account won't open, for Christ's sake, and everybody are facing such problems, right? So because of that, it's still a problem to be solved. And in the same vein, right, if it was a newcomer that made the payment thing easy, right? So I believe that if a newcomer makes mortgage easy, if credit is easier, credit data in Nigeria is still a bit of a hassle, to be honest, right? To get your data on credit and to see whether you can get a good credit, it's still very, very difficult. So if a newcomer makes all that struggle a bit, just by a tiny percentage, it makes it a bit bearable. You see a lot of more entrance into that market. So we just need a big giant to come in and say, I'm solving this big problem that nobody wants to go into.
All right. Maybe Yemi could speak to some of his founder friends to be the big giant to initially solve this problem. All right. Okay. I mean, we don't have much time. Please, our audience, if you have any questions, feel free to drop them in the chat box. We have less than 10 minutes, really. Okay. I mean, so given the global macroeconomic volatility, we are seeing central banks are trying hard to bring inflation down. We are seeing asset reclassifications among investors' portfolio, capital flight, investors' hesitancy to cut checks. So, I mean, where does this leave startup in terms of raising funds? All right. And I want to ask Yemi in 1 minute. So, the current ecosystem, is it a funder's market or a founder's market?
I think it's a market for whoever has capital. Like founders that have capital are happy. Investors that have capital are happy. So when you don't have money, that you are at the poor end of the market, because emerging managers are suffering fundraising because it's very hard now. Founders that are running out of capital are either unable to raise or taking not so great terms from investors. But once you have capital, you're able to run, even if you need to fundraise, you're raising from a place of power. Same with investors. When you have money, you can define terms slightly better.
Okay. So to Mr. K, so I mean, with this trend we are seeing, the hesitancy to cut check, are we about to see a new rise in venture or startup debt?
Okay, I'll just piggyback on the last question you asked, Yemi. And so what I'm going to just mention directly is that, so because, of course, like I said, there's a correction, people are more critical and everybody's looking more at the figures and at fundamentals. So what I will say categorically is that high quality founders will raise money, right? Because now you're looking at the fundamentals and you're looking at it like, okay, what am I getting from this bucket? So I think high quality founders will raise money, and the correction in the market, it's of course there's a focus also on profitability. So I think that would also make things better in that space, right? So as the growing importance goes to fundamentals, to quality of business model, growth, and all that, I think I don't know. This is my thinking. I think the startups in later growth stages will be a little bit hit harder, right? It's not so going to be easy to cut checks already. So I see such in that category being able to, they probably will go for venture debt more, whilst the high quality ones, startup firms, right? They are likely to, and again, I said high quality founders, they are likely to get funding for venture equity. My thinking, because there's a lot of focus, there's a lot of critique going to happen in that space. So I think the focus, I think the focus will be on early stage startups, because of course, they can scale, and there are quite a number of factors that we can throw into that. So those are my thoughts, right? And I think that's what's going to happen going forward.
Okay. So I mean, to Damola now, I want you to wear a founder's cap. All right. So think about it as a founder. So would you be willing to take debt or probably take on equity at a much higher cost?
I mean, there's only a reason I would take debt, for example, and that's the logical thing I would tell any business. If your cash flows are good, then take debt. But if not, don't put yourself in trouble. So if I have good cash flows, that means that you have money to repay debt. Else you just enter trouble and then you'll be struggling to repay. If your cash flows are good, right, and that's coming from a place of good business model, operational excellence, you're able to manage cash properly, right? So if you have all of this in place, in times of and seasons like this, where if you go and do equity, you probably do it at a lower valuation, right? So if your cash flows are good and you have excellent books, yes, debts, why not?
Makes sense. And I think everything still speaks to the business model, your operating model. So I mean, even as we're talking about investors external to the checks, I mean, there are still some startups out there that investors are even willing to give much money to, even the soundness of their business and operating models. All right. I mean, we're gradually going to the end of the discussion. So I mean, now 2023. So let me start with Yemi. So what's your outlook for 2023? I mean, in 60 seconds, really, globally, Africa, and Nigeria. So what's your outlook?
Yeah, I think for Africa, it's probably going to be an increasingly more difficult market to raise, particularly growth equity in. So to my mind, we have a lot of investors that would write the earliest checks, but then as you grow, it becomes harder. And we have a lot of businesses that have historically raised Series A, Series B, Series C. It becomes harder for them to find investors, just particularly because a lot of the investors that write this check have reduced their activities globally. And then Africa inevitably suffers as a result of it. So we've heard things with SoftBank and Tiger last year reducing their rate of writing checks. And then these are some of the biggest players in the market. So I think that's something that will happen. But then as founders try to find ways to make their business economics more solid and then just find alternative ways to just keep growing, maybe not as fast as you once did, but with a clear route to cash flow break even, then I think this year we'll also see maybe some more exit events. Not all might be great, but we would probably see some more exit events. We've seen them grow. It might not be the size we expect, but the exit from Tunisia, for example, was also a very good sign for the ecosystem. I think that's the largest acquisition. And then we're getting these things year on year. There was Paystack, then there was the part of the Wave business, and now there's this. So we'll just see more of these things. I'm not saying everything will come this year, but we would see these over time.
Okay, Mr. K, I'd like you to drill down more on Africa and Nigeria, especially given the context of Nigeria, political risk and regulatory risk, CBN and their typical banning attitude. So what's your outlook for Nigeria?
Okay, first and foremost, it's important to, I think I align with Yemi Damola on quite a number of things. And to first and foremost, it's important to state, I believe strongly, I know actually, as a matter of fact, that there's still capital to be deployed out there, right? And like I've mentioned, it's definitely not going to go to medical companies, right? It's going to be for companies that are really outperforming their peers and showing that they need VC capital, So not just to survive, not to be in existence, but because there's already a solid business model to fund, right? So what I would say for the for startups for 2023, if you are yet to get to that position of solid business model and all that, I would advise that they should continue to bootstrap, right? They should try to bootstrap for as long as possible to achieve, significant revenue growth. Because like I said, when you're looking at the books, profitability becomes quite important. So when you're able to do all those things, then you can go the fundraising route. Because if I have, like I said, a bucket where I have to pick from, I'll look at some of those fundamentals, the business models, before I can pick anything from that bucket, right? So it's quite important that people should bootstrap and just get the right things in place. So yes, I think it's quite a very dicey answer. Money would always chase after very sound business models. And I think there'll be some announcement. There'll be, not increased announcement. There won't be increased announcements, but there'll be funding. There'll be funding announcements, but it will go to the high quality ones like I've mentioned from the very beginning. So I think the growth ones, the growth stage companies, are not likely to get much done this year. And I think Yemi also posted that previously.
Okay, Damola, I'd like you to weigh in on this. Your outlook for the year.
I think for me, 2 words, right? Flight to safety and ripple effect of financial contagion. Flight to safety in the sense, I think, resonates with everything they've said before, in the sense that it's a period where, you're at the risk of recession and you never know how it's going to turn out. So you're going to fly to safety, literally. So safety in the sense that companies that are really good, right? After you've done essential on like very deep due diligence. So you go to companies whose quality earnings, quality cash flow. And secondly, ripple effect of financial contagion in the sense that sadly, in Africa, whatever is happening in developed markets, we always have the ripple effect here. So as a result of financial crisis or not, that will probably go on that will probably, become so broadened in the US and in the European market. We'll see the ripple effect of that year. So definitely interpreting to lower checks, lower number of deals, right? I don't know about exits, right? To be honest, I'm a bit pessimistic about that, right? I don't even measures for this year at least, right? Probably if things pick up from next year, because it looks like it will be for a short term, hopefully. So yeah, we'll see. Hopefully, so we'll see ripple effects of that. But I'm optimistic for 2024, but for not 2023. Yeah.
All right, interesting. I want us to wrap up this discussion by 3:15. So, Yemi, one sector you're bullish on, and one sector you're bearish on this year, and why?
So it's hard for me to pick a sector. Like we are sector agnostic, and then essentially I see exciting businesses across different sectors. So I'm neither bullish. I think maybe pure crypto might be a bit bearish, and that's more reactive just based on what's happening in the market. But I'm very bullish about everything, particularly for a continent like Africa, where we are still 2-3 steps behind the rest of the world. Like I believe there are some sectors that most sectors, if you find strong founders and then they find big problems and just find the right models to tackle it that work on the continent, it could be very big.
All right, Mr. K, one sector, bullish and bearish on.
Okay, so I'm not one to usually want to hide behind the stick and say I agree totally but honestly speaking, of course, we are sector agnostic, so I'm not likely to have a thought about which is going to, but something I just wanted to quickly add, right, is so I don't know, we might just expect a surprise in terms of exits this year, and that's coming from the fact, of course, I don't know what the outcome is going to be, but the NGX, that's Nigerian Exchange Group, NXG, sorry, there's this offensive they're introducing about attracting tech unicorns, to resuscitate the market, because of course the market has been in some kind of comatose for a bit, so it's pivoting towards fintech firms, trying to get them to list and the likes of it. So they're setting up like a NASDAQ style board to consolidate on the fast-growing internet economy and the likes of it. So seems like they're getting something right in that direction. And I think from what I see, they're quite aggressive to get things done. You never know. So I think 1 or 2 announcements might come in that direction if they follow through these conversations. But saying which is bullish or bearish, I'll plead. I'm not like taking a position on that. Yeah.
Okay. So Damola, any sector you're quite fascinated or we do well this year?
So while we are a bit sector specific, right? So I am actually very bullish on sectors that are trying to cover informal spaces, that are trying to bridge, the gap in informal sector. So I'm very, very bullish on retail tech, right? And I believe that we are trying to, solve a real problem there. And okay, for bearish, I agree with you. It definitely has to be anything that has crypto in it, right? Crypto, NFT, I don't think that's what anybody wants to hear from.
But what about the exchanges? What about the exchanges? Those who are actually trying to, like, they're just basically just facilitating
to
payments.
gather everybody. Oh yeah, everybody will have their own share of this bearish market. So my thoughts too. So I don't think anybody wants to hear anything that has to do with crypto for the meantime. So yes, that's
Okay. So the last talking point, I want to talk about exit, and I'm glad Mr. K actually mentioned something in that line about what Nigeria is doing in regards to exit. So I'd like to ask Adeyemi, how would you rate the exit journey for African and Nigerian startups? How would you rate the journey?
So I think for exits, it's probably going to be similar to what happens everywhere globally, which is a lot of businesses die, a lot of businesses get acquired, and a very, very, very tiny percent of startups then go public either through direct listing or by IPOs. And then obviously the dynamics for how you choose to go public is very dependent on how your business and your unit economics work. Because if you're able to get a lot of capital in your business already and you don't really need much money coming in from the public market, you can choose to directly list because you don't need to create additional equity in the business. So I think that's what's going to happen. We'll see a lot of acquisitions. It takes a lot to go public. And I think over time, a lot of founders say, look, we're going to go public. You get to some point where you start to say, do I really want to? There's this one female founder out of Israel that our fund is affiliated with, and a company got acquired, and she wrote a Medium post about it. And then she was like, I'd raised the Series A. And then I thought to myself, there's an exit opportunity now. It's either I get acquired, I think she got acquired by Yahoo, I forget, or I choose to build an IPO business and take everything that comes with that. And then there's a lot that comes with that. So I think we would see that. There are just some businesses that start to look like they're too big not to IPO. And that's one of the fundraising constraints. So you get priced based on your prospects, and then you can then potentially get priced out of what acquirers are willing to buy. But I think we'll see a good mix of all of this, with majority still being acquisitions.
Acquisitions. All right. So to Damola now, I know you know that you're quite fascinated by SPACs. So how has SPACs been, and has this been an efficient exit option for investors yet?
I actually was, right? And then so I saw data for 2022, right, towards the end of the year, and it just shows a dwindling figures for number of SPACs that were issued last year. And I think it's also as a ripple effect of what's going on in the US economy. So I think one of the major things that affected the issuances of SPAC was because the whole essence of doing SPAC was so that you won't go through the traditional legal hassle of a traditional IPO. But because of what's been going on, because of, FTX and the others, right? So that means that they have to also heavily scrutinize SPACs as well. So what's the whole advantage that SPACs were creating IPOs, you could just as well go and do IPO if they're going to scrutinize you this way. So sadly, and it's still looking like that will continue actually. Sadly, the number of SPACs have reduced, right? So IPOs through SPAC, SPACs acquiring companies looks like it's that whole future seems very bleak to me, to be honest, right? Only very few happened last year, and it's looking like it will continue that way, because even now companies won't want to do IPO, because why would you go to a market that valuation will be low, and the public will flog you for a low valuation? Your prices, you're coming from a private sector and you're going to public sector listing, they will not receive you well. So right now that looks like it's not a good future. So they will probably just just to note as well, and based on what Mr. K had earlier said, this is not to antagonize, honestly, but the NGS has always come up with stuff like this. I know a couple of years ago, they came up with a growth board, if I'm right? A growth board that will list companies that are generally like startups, really. But I'm not sure they've been able to follow through with that. I'm sure they've been trying to acquire companies, speak to companies, come and list on the board. But at the same time, in the same vein, it's difficult for startups because you just look at all the processes that you can't miss. If you miss this, you're probably going to pay a fine or things like that. So IPO in Nigeria is bleak. Path is very bleak, and that future is just is very faded right now for me.
Okay, before we take one or two questions, so thank you all for joining. I'll just like our guest speakers, I want us to give one word. So if you would say one word to investors and founders, what would that be? So I'll start from Yemi. One word for investors and one word for founders.
Yeah, I think for investors, like despite the current conditions, you just always remember that this is a long-term game. So don't let market conditions prevent you from being able to do early deals, because you're going to reap these deals in 10 years. And if the market has not corrected in 10 years, there's probably no VC globally, and none of your LPs will take it out on you if there's no VC globally. So that's for the investor. I think for the founders, just really keep building and then make sure you solve big problems, big markets, and you understand your market and problems well. And keep pitching. Don't let investors frustrate you. I know we ask annoying questions sometimes, but yeah, just keep pitching.
Okay, Mr. K, one word for investors and founders.
Okay, I'll make mine 3. Okay, so first and foremost, so if a startup doesn't get to profitability, it's going to struggle to raise further capital in the short term, right? So it's very critical for entrepreneurs to be able to break even as fast as possible. Very critical for startups. Profitability is key. Secondly, for those that raise funds, right, whatever money they've raised, it's important that there's a 2 to 4 times revenue multiple on that capital. That's what will keep you beautiful, or as I might want to describe it. So operational efficiency will be key to startups as they seek to be sustainable over the next 12, 24, on average 18 months of whatever the this year would be, whether it's a downtown or otherwise. And lastly, for investors, LPs, potential LPs, so if you're a risk lover or whatever it is you might want to call it, the best time to be on the streets, contrary to what some advisors will tell you, is to be out there when there's blood on the streets, right? That's the best time to actually invest, when others are holding back. And of course, I'm not saying, look to those that carry out the fundamental reviews, that will do all the necessary due diligence. But I think the best time to invest is when nobody is. Thank you.
Okay, Damola, one word, investors and founders.
Okay, for founders, I will just say focus on what's important, right? Which is your business, the model, right?
Okay, I think we lost Damola.
Sorry, can you hear me?
Right. Okay, we can hear you.
Yeah, we can hear you now.
Oh, yes, apologies. I think my internet went off. So I was saying that for founders, right? I think just one word is focus on what's important. Your cash management has to be a par. It has to be excellent, right? And you have to show concrete use of it, right? It should not be on ephemeral things. And for sorry, excuse me. Okay, and for founders, right? This is the best time, to be honest, right? This is the best time to come in, right? Because, well, in looking at companies, you actually be able to look at companies that will actually provide the value that you're looking for, right? And what best time to see it than a time of low growth in the market? So this is the best time to come into any markets, honestly. Yeah, thank you.
All right, thank you. So let's just we have 2 questions on the Q&A, so I'll just ask Fola to take the questions briefly.
All right. Okay. So there's one directed to the Oak Capital. So since we have the founding partner on the call, I'm pretty sure can do justice to that. So the question is, or rather, it goes thus: it seems there is information gap between the VCs, enablers, and the founders. Does the Oak Capital have a plan to create a sharing ecosystem? Perhaps with a checklist aligned to the status quo of 2023, so we can have current knowledge. So I think what Charles, who actually sent question, is trying to ask is, for the founders who are trying to, raise money, what can the O Capital or similar funds in the O Capital's regard do in terms of sharing information to bridge the information gap between VCs, the enablers in the ecosystem, and the founders?
Okay, so my muted. Okay, so when what I'm not quite clear about is the information gap, right? I think I'm a little bit lost. So, Fola, if you have an understanding, let me know. Or if the person that asked the question can help me throw some light into that information gap, it would help me.
Okay.
Information asymmetry.
Charles,
I'm wondering what angle. Charles, if you are there.
Charles,
okay, hello, good afternoon.
Good afternoon.
Good afternoon, Charles.
Good afternoon, sir.
Yeah, can hear you.
Yeah, so this has been an interesting an interesting session. I just got promoted to a program, so I'm kind of learning on the job. But my question is, I think Damola said also, there are new business ideas coming up, and we play in the agri-tech. So a new company comes up, or there's a new business idea, and we need knowledge. Okay, the VCs, for example, the VCs have money, and they want to probably invest in startups, for example. There are enablers like maybe environmental institutions or the like that can kind of bridge the gap between the VCs and the founders. And then there are the founders that have the startup. So where does O Capital come into play? I don't really understand the full business of O Capital. But I'm asking, we need the kind of synergy whereby the VCs know the kind of startups that are coming up and can probably have access to their business model. And then the startups need to know the kind of VCs that should probably approach. So there's kind of information gap for new startups especially. Thank you.
Okay, right. Okay, so I think I have an idea of what you just asked. So two things are quite critical. Number one, you talked about new business ideas. So when you have a new business idea, the first thing that comes to mind is not for you to go and raise money. I think you need to do accelerator programs, bootstrap, get people to, let me use the word, some kind of mentorship to guide you through that process of how you convert your ideas to how you get a business model out of it, right? So before you even talk about funding, in my opinion, I think you need to get your business model right from your ideas. So once the business idea comes to you, by all means, our doors are open. You have Fola, you have Biodun, we have quite a number of people in our team that can help you fine-tune some of these ideas. And if you need to do some kind of accelerator program, would refer you accordingly. Then, of course, the next thing now comes to funding. Funding, like we mentioned, we are sector agnostic, so we can speak with you as regards the funding, and we can lead you in the right direction. If so, for example, just to help the information asymmetry you talked about, you have quite a number of firms that have some sectors they fund, right? But that doesn't come into place because we are agnostic. So you can talk to us, and after this conversation, get the contact of any of, I think they'll share any of our contact lines or emails. Then the Acorn, we have a, should I call it a product? Acorn coming up very quickly or very shortly. In fact, I think it's something you should subscribe to. Fola Juwon will share the details of that. So what the Acorn is designed for, if Acorn is an offshoot of the Oak Capital, Acorn is a baby oak, right? So what we're trying to do is we are throwing some light or focus on still on the served in terms of the Nigeria ecosystem, the VC space, where we would we'll be able to bring is it Charles? We can help Charles with whatever idea he has to the next unicorn you have in Africa or the world, as the case might be. So please, we'll be happy to talk to you, and you'll be a part of our Acorn program, and we'll take it from there offline. Hello.
Thanks a lot for that. I really appreciate it. I will have to follow their LinkedIn as well. Thank you, sir.
Okay, awesome. Thank you very much.
I would check my LinkedIn and send you my mail. Then you can actually correspond from there. So we have another question from Cynthia, right? She's asking, what are your thoughts regarding leverage on what are your thoughts regarding leverage online marketplaces to discover startups to fund? How effective is it? How is fundraising still dependent on relationships, especially when you think about the gender gap with founders and myopic perspective towards the kind of startups being funded? I'm trying to get the question here. What are your thoughts regarding leveraging online marketplaces to discover startups to fund? Is Cynthia on the call so she can actually throw more light to this? I'm finding it a bit hard to understand this question. Cynthia, she on this call?
Can you hear me?
Yes, we can.
Hi everyone.
Hi.
Right. There was, the conversation earlier about in terms of female founders, not females, female founders not getting enough funding. There's also the perspective of, okay, how many startups can a VC get access to based on the people that they know, right? And that might limit the number of startups and the kind of startups that they can actually fund. So I see a lot of platforms like DoorDash that are building marketplaces for investors to find startups, right? DoorDash is an example, and there are many others, right? I want to know if that system is really effective. I just want to get the perspective of the investors, if that is a very useful platform, or if it's still preferable to look within your network and invest based on recommendation as it is right now. So yeah.
So did Damola or Yemi, or Mr. K, did they get any other question? Yemi, would you like to?
I got the question. So deals come from everywhere. I think historically the reason a lot of investors probably leverage warm interest because sometimes it's higher quality deals that come through warm interest. But I think irrespective of the channel where it comes through, we will still take a look. The thing with marketplaces is discovery, because I doubt every investor is going to be on every marketplace that exists for startups. So if possible, it's nicer to reach directly. It could be a cold email. It could be going to investor websites where they have the forms. So at least that way you're very sure these investors are looking at your decks. But then we also do outbound, and the marketplace would be some form of outbound where we're just looking generally and then we find startups. But then I always advise founders, look, you need to be a bit intentional with the fundraise. And rather than I go to a marketplace, let investors come and find me, it's best to find a way to contact the investors. This could be sending a random LinkedIn message with your deck, cold email. Most times if you do first name dot last name or first name, you get hit in most funds. Or just find LinkedIn connections. So it's sometimes their connections that really aren't connected. But then if you find enough connections, you can also use that. But I think to a large extent, most people will review the deals, and then potentially you would find a hit more easily than through a marketplace.
Okay. All right. Thank you, everyone. And that brings us to the end of this interesting conversation. We meant to use an hour really, but the discussion was interesting and we had to spill 30 minutes extra. But I'd like to thank everyone for taking our time to join this webinar. And I'd like to also especially thank our guest speaker, the founder, the Oak Holdings, Mr. Olukunle, Damola, and also Adeyemi. Would like to say a very big thank you to you, and we trust and we know that when we call on you next time, you'll be willing to indulge us. And also I want to especially also thank everyone who has joined. Thank you, and let's take this conversation even further away from here and let's see how we can together support the ecosystem and build a prosperous Africa and global stage at large. So thank you everyone, and do enjoy the rest of the day.
Thank you, everyone.
Yeah, thank you. All right.
Thank you.
All right, thank you, everyone. Enjoy the rest of your day.